Hi everyone, my name is Linda and I'm a Fixed Income Analyst at iFast. Amid the ongoing US-Sino trade tensions, geopolitical uncertainties and growth concerns, investors' preference for low-risk credits has increased this year. In this video, I'm going to introduce a couple of high-quality bonds issued by Singapore Airlines, the SIA 3.145% 2021 and 3.16% 2023 SGD bonds. SIA is a well-established leader in Singapore's aviation industry. Furthermore, SIA also fully owns the local aviation brands SIA and Scoot. The company reports 5 main business segments by brands such as Singapore Airlines, SIA, and Budget Aviation. More than half of its revenue is derived from the brand Singapore Airlines. SIA delivered healthy profits in the quarter ended June, with top line rising 6.7% quarter-on-quarter to 4.1 billion. Operating profit likewise saw an improvement of 3.6% over the quarter to 200 million on the back of rising aviation demand. While increasing aviation demand denotes a bright aviation outlook, heavy capital expenditures inherent in the aviation business may lead to rising leverage at SIA. Higher interest expenses could in turn translate to worsening operating metrics. Other potential risks include fuel price volatility and fleet disruptions, such as the global grounding of the Boeing 737 MAX 8 aircrafts. That said, SIA continued to generate healthy operating cash flow, thanks to the aviation industry's operating model of collecting cash from advanced bookings. In its last financial year, SIA generated 2.8 billion of cash from operations, or CFO. Total debt over CFO stood at a decent 2.4 times in that year, meaning that the group could theoretically generate enough operating cash flow to fully extinguish its debt in 2.5 years. SIA's credit profile is healthy, which should help to offset its operational risks. The company's refinancing risk is low in our view, with just 223.1 million of short-term debt at the end of June, against 2.1 billion of cash and bank balances. Furthermore, these short-term maturities are mostly secured against aircraft-related assets, so SIA should be able to roll over them easily. Interest coverage of 0.3 times over the 3 months ended June still represents a comfortable margin of safety in our view. SIA's bonds carry yields to maturity ranging between 2.2% and 3% for tenors between 1 to 8 years. We think the bond yields have reflected the likelihood of parental support from Temasek in times of need, given its 56% ownership in the company, as well as SIA's market-leading position in the aviation sector. Among the list of SIA bonds, we like the SIA 3.145% 2021 and SIA 3.16% 2023 SGD bonds. They carry RSU to maturity of 2.3% and 2.6% respectively, representing 74 bps and 104 bps above SGD swaps. Between the two, we think the 3.16% 2023 bond looks more attractive, given its decent yield pickup of 30 bps for the longer tenor of 2.5 years. If you are interested to know more about our thoughts on Singapore Airlines, please click on the article link below.